Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the financial drama unfolding behind the suits and ties. And today, folks, we're looking at Whitestone REIT. And let's just say their latest report is all about big credit, bigger dates, and some very interesting cost adjustments. This is not just another day at the office, it is a significant financial maneuver for Whitestone REIT, or WSR as you LLC it on the stock exchange. VED just inked a brand new credit deal, and this is instead just a small top. Up on their credit card, this is a substantial unsecured credit facility worth a cool $750 million. Think of it as a major financial upgrade, like going from a compact car to a whole fleet of delivery trucks for their business. What does this mean for Whitestone REIT? Well, it signals a big vote of confidence from the lenders, and it is about giving the company more firepower for its operations and growth plans. They've essentially refinanced their existing credit agreement, giving themselves more room to maneuver financially. This new facility, called the 2025 facility, is divided into two main parts. First, there is a revolving credit line for $375 million. This is like a flexible credit card that they can use, pay back, and use again. It is set to mature in September of 2029, but they have options to push that maturity date out even further, all the way to September 2030. This long runway gives them a lot of stability. Then there is a second part, a term loan, also for $375 million. This is more like a traditional loan that they pay back over a set period. This loan has a maturity date in January of 2031, which is even further out. Now, what is really interesting here are the interest rates. For the revolving line, it is based on something called term SOFR, which is essentially a benchmark interest rate plus an additional percentage. Right now, based on their financial situation, that extra bit is 1.40%. For the term loan, they actually entered into agreements called interest rate swaps to lock in their borrowing costs, which is a smart move in a rising interest rate environment. They've managed to get some pretty specific rates that are a bit lower than the revolving facility depending on the period, with the current applicable margin a bit lower at 1.35%. Let's break down some of these terms. Base rate is like a default interest rate. It's the highest of the bank's prime lending rate, something related to overnight money market rates plus 0.5%, or the term SOFR rate plus a bit more. And term SOFR is just a standard way of calculating the interest rate based on the broader market. It sounds complicated, but the key takeaway is that they have a choice of how their interest is calculated and have actively managed to secure favourable rates on their long-term borrowings. Now, a big change here is that a previous 10 basis point charge on their SOFR base loans has been removed. Think of basis points as tiny fractions of a percent, so they've shaved off a small but meaningful cost from these loans. They also managed to extend the maturity dates for both parts of this facility. This is huge because it means they have more time to repay these massive sums, reducing the immediate pressure on their cash flow. And on top of that, the fee they pay for simply having the revolving credit line available, even if they don't use it all, has been cut by 5 basis points. This is a nice little perk, especially when they are using less than half of that available credit. It shows that the lenders are willing to offer better terms. So, what did they do with this brand new $750 million credit line? Almost $83.2 million of it went straight to paying off old debts on their previous revolving credit line. Another big chunk, $285 million, was used to completely pay off their old term loan, and the rest, about $6.8 million, covered the fees and expenses associated with setting up this whole new deal. Basically, they used a lot of this new money to clean up and streamline their existing borrowing. The company announced this deal on the 22nd of September, a few days after they officially signed the papers. It is always good to see companies being upfront about these major financial moves. This whole agreement is with Bank of Montreal as the main agent. Essentially, Whitestone REIT Operating Partnership LP is borrowing the money, and Whitestone REIT itself is providing a guarantee, meaning they are on the hook if their operating arm can't pay. So, what is the big picture here? Whitestone REIT is proactively managing its debt. They've essentially swapped older, potentially less favourable debt for a much larger credit facility with improved terms and significant extensions on when they have to pay it back. This strategy often indicates a company that is confident in its future ability to generate cash. They are securing funds at what they likely believe are good rates and locking in repayment schedules that give them breathing room. It is a move that supports potential growth or simply provides a stronger financial cushion. On the upside, this gives Whitestone REIT significant financial flexibility. They've significantly lowered their immediate debt repayment obligations by extending maturities and have potentially reduced their overall interest costs by eliminating that 10 basis point charge and adjusting rates. This financial strength can be used for strategic initiatives, capital expenditures, or to weather any unexpected economic storms. However, the risk is always in the execution. While they have more time to repay, the total debt remains substantial. The company needs to ensure that its underlying business operations are strong enough to generate the revenue and profits necessary to service this debt over the long term. If their properties don't perform as expected, or if the real estate market takes a downturn, managing this debt load could become challenging. In conclusion, Whitestone REIT has made a substantial and positive move to strengthen its financial footing. By securing this new credit facility, they bought themselves time, potentially reduced costs, and positioned themselves for greater operational flexibility. It is a sign of a company that's thinking strategically about its financial health and future. Alright, that is our breakdown of Whitestone REIT's latest filing. What is your take on these numbers and what they signal for the company? Future. Do you think this massive credit facility is a smart play or a sign of underlying stress? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and make sure you subscribe to Corporate Decoder for more deep dives into the world of corporate finance. And don't forget to join our Discord community, linked in the description, to chat about these reports and more. Thanks for watching, and we'll see you next time.